In this presentation, we will work a problem related to forecasting, projecting out into the future, being able to do what-if type analysis in the future. This is one of the major benefits of the CVP analysis. In other words, once we break out the costs to variable and fixed components, we can then project out into the future very easily and run different projections as we do so. That's usually what we think about when we think about these fixed and variable costs, how we can then use them to project out into the future. Of course, you want to consider the fact that when we do these projections, we usually take the past numbers and we break out and use them to help us to know what the fixed costs and variable costs will be, that we can then use as a starting point to project out what they will be in the future and then run scenarios with them. We're going to break this out from scratch in a new Excel worksheet, practicing putting these tables in place. We want to be able to do this pretty quickly and be able to build Excel tables with this type of information, know what the Excel tables would look like, and then be able to write them out by hand in terms of the format of the tables when we so choose. It'll be a lot easier to learn Excel. It's a lot more applicable. I'm going to start off by highlighting the entire sheet. I'm going to right click and format the sheet, and we're going to make it currency. I'm going to do the formatting fairly quickly. It will also give you a pre-formatted worksheet if you'd like to use that as well. But we want to go through the formatting for practice. We're going to use the brackets, no $ when we start off. This is going to be our data on the right. I'm going to put it in this format, just in the same format. In a book problem, you might see this in a paragraph type format, and you're just going to have to pick out the data. You want to put it at the top of your worksheet and format it in the top of your worksheet because that's what you're going to reference to. So that's what we'll do now. We may first by titling the worksheet. I'm going to call it forecasting, just like we did over there. Let's add the G to it. We'll make this worksheet a little bit larger, easier to see. I'm going to select the plus item to zoom in on it up to about 140 for now. So I'm at 140%. I'm going to put my cursor on A1. We're going to go to formatting to the home tab. The styles, I'm going to format this to a title type format, and that'll be our starting point. And then I'm just going to put up top whatever information. I'm going to read through the problem, put it down the information I think is relevant. So I'm going to say and obviously here it's already basically the relevant information is already here. So we're going to say the current sales price. Now I want to make sure to put the price in a different cell. I'm going to make this cell larger and I'm going to say here's the price, 145. I'm going to make the entire thing bold as well, just because I like it bold for some reason. I'm going to highlight the whole thing, make the whole thing bold. That means we can't really emphasize anything in particular, but just make it easier to see here. So then we're going to say current variable costs per unit. And so I'm going to make this a little bit larger so we can just be over here and say that's going to be 87. And then it gave us fixed costs. So I'm going to skip a line just like we did over here. I'll explain why in a second. Fixed costs. And that's going to be, I always keep on missing the S on the fixed costs. I think the finger's not working. 368,000. And then we're going to say that we have the estimated sales price in units. That's going to be 40,800 units. And then we have the estimated sales price. Oh, I'm sorry, this is the estimated sales in units. Estimated sales price, 208. Then the estimated variable cost per unit, 148. And the income tax rate is going to be 35%, 0.35. So now we could do some formatting on this, and we might want to go through and say, okay, what are we talking about in terms of numbers and dollars? What's in terms of units? And we could add decimals to do that. So I'm going to go ahead and do that. This first one is $1, so I'm going to right click, format this. Let's add currency and add the dollars. This one is a unit, so I'm not going to have it there. This one, fixed cost, that's $1. Estimated sales in units, that's not $1. So I'm going to have this one format. Let's put currency and add the $ there. Make this a little bit larger. This one's in units. That's a dollar amount. So I'm going to right click, format cell, and make that $1. And then this is estimated variable cost per unit. So that's going to be a dollar amount, format, currency, add the dollar sign. And then the income tax rate, income tax, let's make that a percentage. Home tab and percentage here. Okay, so there we have our formatting. We could put a box around all this if we so choose. I can move this out of the way now. Make this a little bit larger. We'll go to the home tab, we'll go to these items, and we'll set a box around it here. And then again, we could remove the decimals. We don't need decimals possibly. We'll work without them for a while at least. So there we have it. Now, note what we have here. We've got the current information, and then we've got the estimated information. I want to put that there. We're going to be working with the estimated because we're projecting out into the future. But you want to consider in a book problem, they're often going to confuse you with basically, here are the current numbers, here are the estimated numbers. We're forecasting into the future. We're typically working on the estimates, but of course, those are coming from the current numbers. Whenever you think about the projections into the future, it's always going to say that we're not reliant totally on the past, but that's going to be the starting point. Typically, we'll look at the past numbers. Here's the sales price in the past. That's one of the things we could change. What is the sales price in the future? If we say the sales price in the future is going to be 208, then that's what we will use in our projection. Obviously, if the 208 is higher than the 145 that we had last year or last period, and therefore you would expect possibly the volume to go down unless we change something else, like the advertising or something like that. You can see how all these variables can come into play. We can work through those variables a lot more easily with the CVP type of analysis. We can think about these projections a lot more clearly with this type of analysis. Now we're just going to break out our standard kind of contribution margin type of income statement. So we'll say this is our contribution margin income statement. This is our forecasting tool. This is our forecasted contribution margin income statement. And we're going to say, okay, there's the sales is what we start off with. That, of course, is going to be similar to a normal income statement. But then instead of cost of goods sold, we have variable costs. So that's going to be our second line. And then we'll subtract those two out. Instead of in a normal income statement having gross profit, we here have the contribution margin. Contribution margin. I'm going to delete this. And then we're going to have the fixed costs. Fixed costs. And then we're going to say this is going to be our income. But this time we're going to say income before taxes. Because then we're going to have the taxes. And then say it'll be net income after taxes. So we're going to include the tax in our calculation here, or at least estimate for it. Now we're going to start off with the sales per unit. And that's going to be our starting point for us to make that projection. So I'm going to say, okay, the sales per unit is going to be our estimated number, not the current number, because we're projecting out in the future. This is what we say it will be. And that's going to be the 208. And then the estimated variable costs are the 148. How would we get these numbers? Well, the sales price, it is what it is. The variable costs, we'll see what they were last time, and we'll make any adjustments that we made. So where they're going to be substantially different in this time. The contribution margin then per unit is the sales minus the variable costs. Now I'm going to highlight all of these items. I'm going to right click on them. I'm highlighting this whole row. I'm going to remove the decimals here, just so we'll don't have to worry about those. And this is the per unit numbers. So this is per unit. And then we can have the number of units that we have, and we're going to add this column here. We're not always going to need this column because we might want to just use this number up top, as we'll see next time. But I'm going to keep this number now. I'm going to say the units are going to be there for the sales. This is the number of units up top. So this is our estimated number of units we're going to sell. And those are applicable to all of three of these items. That's the point, because these items, sales, variable cost, contribution margin, will act in a linear type of fashion with relation to the units. And therefore, if we have the total, then we could say this equals the 208 times the 40,008, and that'll give us our total sales. We can then take the variable costs times the units, variable cost per unit times the number of units. That gives us our total variable costs, and we can calculate this two ways, the 60 times the 40,008, or we can take the 8,486,400 minus the 2,038,400, and we'll get the same number. So there's going to be our items there, and then the fixed costs are just going to be fixed. They are what they are. Here's the fixed costs. And then the income before taxes will be, let's put some underlines here so we can underline these two items, and we can underline this item. So the income before fixed costs is going to be this number, our contribution margin minus the income before taxes. We're going to say our tax rate is 35%. So I can just say this equals the income times the tax rate of 35%. That's the 6,335, and then we can take our income before taxes minus the taxes, and that'll give us our income number here. I'm going to go ahead and underline this, and then we will double underline that. There we have it. So we can make this then the total, and then we can clean this up. So notice how nice and easy that is to basically set this up. We can put these numbers in, we have this projection out there. Now that's not the nicest part of it. The nicest part of it is that we can then make adjustments. This is usually the key number that we're going to make adjustments on. So now we have this number. It's all driven by formulas. Everything is a formula here, and therefore if I change the data set up top, then the numbers down below should change in accordance. So therefore I could say, okay, well, what if we didn't sell 40,800, but we sold 50,000? Once we hit enter, it'll then change these numbers automatically for us, and we'll have our new numbers here based on the 50,000 units. That's the beauty of the CVP analysis, the contribution margin income statement, what we can't do with a normal income statement. If I only sold 30,000, there we go. If we want to try to figure out the break even by just kind of estimating here, we could say, well, what happened if I sold 20,000? 20, not 2,000, and see what happens there. What happens if we sold 15,000? Right, we could 15,000. That's going to be the 170. What about 10,000? Right, now we're negative. What about 11,000? And we can kind of see what the net income would be. Now, of course, we can do the break-even calculation to figure out what it is and know exactly what it is, and then plug that number in here if we so choose. But notice we can estimate like this in a way that we cannot do with a normal income statement, at least not easily. Now, there's another format we might want to set this up in. So let's clean this up. Let's make some blue lines and say, okay, we'll make this blue and make this our blue item. And we'll put the grid lines in, possibly, then making this black, maybe, and then blue up top, and maybe centering that. I know I did that quick, sorry, but it's just some formatting stuff. And then we can do the same thing down here and maybe format it a little bit differently, because maybe I want to see these items side by side. So if I said, okay, let's put this back to the 40,800. There's our numbers here. What if I want to see side by side what would be the net income with the 40,800 compared to something else? Well, we could do a similar calculation. I'm going to go ahead and copy this whole thing. I'm going to just right click and copy this. Let's put it underneath, right click and paste. So there we have our items there. Now the formulas don't work, right? Because we've pasted them down. I'm going to recreate this. I'm going to highlight this. I'm highlighting these rows, and what I'm going to do is hide these cells. Right click on that area and hide those cells. And then I'm just going to recalculate this fairly quickly. So we're going to say that the per unit sales per unit is this item. Variable cost is this item. What I want to do is remove the units, because I don't want the units down here. I'm just going to represent them up top in our worksheet. So what I'm going to do is I'm going to remove or hide this item. Let's go ahead and just make these 0 here. Don't delete the row, but I'm going to hide the row so that we don't see it there. So now we've got hidden rows here, or hidden columns. And if you don't want to hide the columns, then you could do the same worksheet, or you can use a completely different worksheet if you'd like to just redo the whole thing. That would work too. So I'm going to delete the total, and I'm just going to put the number of units here. So I'm not going to use this total. I'm going to hide this in our data too. Let's highlight that the whole row. I'm going to hide that and say, now we're going to just put the totals here. So I'm going to say, what happens if we had, let's say, well, let's do the same, 40,800. 40,800 amount. If we multiply this out, then we're going to do it this format. We're going to say this equals the sales, 208, times the 40,800. This representing our units, our projected units. And then I'll say enter. So there we have that. And then the next item we're going to say is the variable cost, 148 times the projected units. And then enter. And then we could subtract these two out. This equals this number minus this number, or it would be the same, just so you can see this number times the 60, same number. And then the fixed costs are now going to still equal this 368, and the taxes is going to equal this number times the tax rate. So there we have our same numbers. Now if we highlight this whole thing and I pull it over, I'm going to use autofill to do this now. I'm going to highlight this whole thing. We're going to put our cursor on this square so it looks like that. And this is autofill. We're going to left click on it and drag it to the right. And so now we have a new set of numbers. Now let's see what happened here. What I'd like to do is be able to change this number up top to something different, say 20,000, and have everything changed down below. Now it's not calculating correctly. Let's see why. If I took that 20,000, notice it's pulling over the cell to the next cell down, and that's not what I wanted to do. So I'm going to say, okay, how can I change that? What I wanted to do is take 20,000 times the 208. I could retype that formula in here, but I'd rather not retype it in here. I'd rather do it a different way. So I'm going to say, all right, let's delete that and think about how can we do that. Well, this number is the 208 times the 40,000. When I pull it over to the right, I want the 208 to remain the same and the 40 to move. So this cell in B22, I then want to call it an absolute reference. I'm going to do that by selecting F4. That puts a dollar sign before the B and before the 22. And that just means don't move that cell when I autofill over. Use the same formula. That'll make sense when we do it, so we'll show that. You could just retype the formula too, that would be fine. And then we're going to say, okay, here's the 40,008 and the 148 in B23. I'm going to take that cell and F4, and that means I'm going to make an absolute reference of that. Don't move that cell over. The dollar signs have nothing to do with dollars here, by the way. They're just that's just what they're using here. So we're going to subtract those two out. They're using that as a code, like a computer code, not as any reference to dollars. And the subtraction, we want those two to move over as they are here, so that looks good. The fixed costs, now this is being pulled from that number. If I pull it over to the right, the relative reference that'll happen is it'll move this over to D. I don't want that to happen. I want it to keep pulling from that number. So I'm going to F4 on that one, absolute reference that one. And then this one is correct because if I pull it over, it's going to move to column E. It's going to subtract column E cells, and that's what I want. And that'll be the default. The default is usually right. Excel will kind of move everything relative. That's what Excel will do. And so now on this item, we want this one to move relative when I pull it over. But this one on the income tax, I want it to stay the same. That's in B10. So this one in B10, I'm going to F4 that one. And then this item is going to be this minus that. Those both should move over to column E. So that looks good. So now let's go ahead and do this again. I'm going to highlight this whole thing. I'm going to put our cursor on the autofill, drag it to the right, and see if it does what we want. I'm going to open the cells up a bit. So there we have it. And it looks pretty clear. It looks good. If I had the same number here, then we come out to the same number. So that looks pretty good. Looks like it does what we want. So in other words, this is now taking this cell times that. Why? Because we absolute referenced this number. So it didn't move over, didn't do a relative move over type of thing. And this number did do a relative. It moved from here to here. And then this cell taking this number, which did not move over, times this number. This one is subtracting, and those two did move over from column D to column E, which is what we want. That's the default. And this one, absolute reference, because we didn't want anything coming from our data set. We usually don't want that to move, so we absolute reference that. This one did move over from D to E. That's what we want. And this one didn't move over, absolute reference. This one did move from D to E. That's what we want. And this one, both of them moved over. And now note what we can do. I could say, well, what would happen if we were at 20,000? And we could say, boom, and it changes everything. And we could see this in a comparison type of format. So now we've got this one on this side. Oh, and we can run projections and see it in a side-by-side type of fashion. And of course, if I copy this over as far as we want to go, I could say, all right, what if I copy this all the way over here? Make this all a little bit wider. And say, all right, this is going to be 20,000. This is going to be 30,000. This is going to be 40,000. This is going to be 50,000, 60,000, 70,000. And we could basically then see this is where we started. We could see our relative net incomes in our increments as we're increasing in this type of format. This is what's nice with the CVP type of analysis. We can do these types of changes. If we run scenarios where we're going to increase advertising, possibly increase the fixed costs of advertising, and possibly sell more units, then basically selling more units up top, that would be a common type of scenario where we can just change this number in our data set. We can just say, well, you know, we think that fixed cost is going to go up to 700,000. And so that means that in all of our numbers down here, the fixed cost goes up, and we think that that's going to be around that's going to increase our sales to like 60,000 from what it is now. And we can run our calculations based on changing very few numbers in the data set and having to think about much less complex type of variations than we would have to if we were thinking about sales minus cost of goods sold minus other expenses, because the cost of goods sold has variable and fixed components. We couldn't just think about it as easily to get to that bottom line net income number as if we break it out in a CVP contribution margin type of income statement and then use this format for projections with it.